Guys, welcome back to the Independent Investor channel, coming to you from the Big Apple, New York City, New York. My name is Ryan. It's so good to be with you. Guys, listen, this is going to be a fun episode where we actually employ some of the ideas that we talk about on the Independent Investor channel. We talk about the specific accounts that are necessary to become an independent investor, right? To enjoy all the benefits and to keep all the profits wealth preserving and enjoy all the tax benefits within the self-managed Roth IRA accounts for guys. But this is a realistic discussion about hearing out somebody's risk tolerance and their age and how much they want to invest, and really start to take those information and really build out a portfolio that's going to help that individual. In this particular example, I've got spouse number one and spouse number two. This is actually a real example of a couple friends of mine. So to protect anonymity, we're going to call it spouse one and spouse two. All right. And I just kind of want to walk you through some of the thought processes of actually taking the easy steps that it'll take to actually build out a portfolio. All right, guys. Listen, if you have not subscribed to the channel, please hit the subscribe button at the bottom. Drop the comments in the comment section. If you can give me the big three with regard to your age and your risk tolerance and how much you have per month, I think you're going to be surprised at the information that I send back to you guys and kind of get you excited about your own particular potentials as an independent investor channel. So hit me up, guys, and we're going to go ahead and start with spouse number two. All right, and these particulars came from dialogue that I had with this particular individual, and just kind of through discussion, kind of understanding where they were coming from, a beginning investor, mid-20s, right? And this situation or scenario plays itself out, 1,000 times over. There's so many people out there in their mid-20s that have all kinds of stuff going on, right? They're finishing school, they're trying to start a career, maybe they're trying to start a family, so they have everything up in the air, and this is really not the most opportune time to be talking about finances, but it's actually the most important time to be talking about finances. So it's actually really difficult. It's also a time where you don't know a whole lot, or you haven't had a lot of experience in the market. Really, you may only know what you've been told or what little bit you've been recommended to, guys, right? So it's really important to be honest with yourself, right? And just by talking to this particular person, the first thing that was offered to me is that investing is like gambling, right? And that kind of keys me off a little bit to, of course, where that individual is coming from. Not a lot of experience, but coming with another concern that a lot of people offer to me is that they don't want to lose money, right? Nobody wants to lose money, okay? But if you have never invested one single dollar in stock, you have to give yourself a chance to actually make money. Don't justify not investing because you think it's gambling or because you don't want to lose money, okay? Because, guys, those are not valid reasons to not invest and secure your financial future, okay? Now, without missing a beat, this particular individual on spouse number two shows an interest and want to invest, okay? So on one hand, they're like, okay, it's like gambling and I don't want to lose money, but I also know consciously that it's one of those things that you have to do in life if you want to secure your financial future, okay? You have two choices. You can either not invest, which is a choice, and you can guarantee that the future results on not investing will be zero capital appreciation, okay? Now, that's a choice, all right? And you have to tell yourself that you're choosing to do that if, in fact, that's the course that you want to put your financial future on, okay? And that's respectable. I respect anybody who makes a cognitive choice not to invest. That's totally fine. But you have to understand what you're giving up by choosing not to invest as opposed to choosing to take the hard steps to actually invest, okay? Now, when we want to go ahead and assign a risk tolerance to spouse number two, we go ahead and assign a risk tolerance of 3, all right? Now, if you haven't tuned into my previous video uh, specific to assigning risk tolerance, I look at it from an arbitrary scale of 0 to 10. 0 being, I want nothing to do with the market. I never want to invest. Don't even talk to me about investing. I'm not interested at all. To being a 10 and being able to endure any foreseeable or unforeseeable outcome that the market could throw at an individual, and you're not going to bat an eye. You're not going to lose sleep. You're going to stay steadfast in your program, and you're going to keep those investments going forward. So from 0 to 10, all right? So a beginning investor who's got this level of concern with the investment world but wants to get started and just doesn't know how, all right, we assign a risk tolerance of 3, and that can adjust over time, right? You get some years of investing under your belt. We get that above a 5, 6, 7, 8, 9. We increase our tolerance, right? As we get more practice, guys. But you're not going to have that practice and experience if you've never invested before. So be honest with yourself about assigning an appropriate risk tolerance, all right? So when we come down here and we take all this into consideration when we're looking at spouse number 2, I'm looking at putting this individual into the ticker symbol VOO, which is Vanguard's index fund, or excuse me, ETF, which mirrors the S&P 500, all right? It's actually got a year-over-year rate of return of close to 15% in this particular ETF, all right? And it's got an expense ratio that is insanely low of 0.05% maintenance fees going forward. So if we put this product to work inside of the self-managed Roth IRA, all right, which is something that we should do, the self-managed account under both of these is the critical first step before we start talking about putting these pieces to work underneath of spouse number 1 and spouse number 2, okay? So the self-managed Roth IRA, we start in the dialogue of understanding where somebody's coming from, and then we start to kind of brainstorm and float some ideas out there about what can meet some of these needs within this particular portfolio, okay? So the VOO, the Vanguard ETF that tracks the S&P 500, super low fee, phenomenal rate of return. It's extremely diversified amongst the entire index, and that meets the intent of, addressing this need here of this individual not wanting to lose. And we don't want them to lose sleep because of the investments that they're in, right? So we put them in a product like this, all right? And then maybe we earmark a couple things down the line. Once we've got this kind of working for a couple of years, investing in the VOO, then we start to look at, potentially adding a cornerstone investing. Now, this particular individual, for their occupation, is involved in the healthcare industry. So a couple things that was mentioned to me was, what about pharmaceutical companies? It's like, okay, well, I own J&J and I also own Pfizer, so those are a couple really good options on the healthcare sector, right, that we can add to this particular portfolio. We can start the dividend reinvestment program for this particular portfolio, and it starts to build going forward. And when I was asked about my opinion about apparel, right, we've got Nike and Adidas. I like Under Armour, but it just got whacked on its last quarter, reported a really bad quarter with regard to the amount of inventory it had. Nike is a phenomenal, safe company. It's relevant because it's been around forever, and they've got some really good technologies going on within Nike, all right? Adidas is the growth story, so I wouldn't recommend that in this particular portfolio, but for this risk tolerance, I'd absolutely recommend maybe looking at a Nike to put in that portfolio to diversify it a little more, all right? So great, we've got spouse number 2 built out. Then we come over here to spouse number 1, all right? Now, these guys are married, okay? We talk about a completely different approach here when we look at spouse number 1, all right? Again, the same comment, investing's like gambling, right? All right, it's just like gambling. I'm gonna put my money and maybe I'll win and maybe I'll lose, okay? If you haven't tuned into my Bullseye video on gambling, investing like gambling, I highly recommend that you check that out, all right? And we dispel that notion within a 5-minute financial piece, all right? The second thing here that's different from spouse number two is that spouse number one says, I don't understand going into index funds and ETFs and becoming a passive investor. I want to invest in stocks, right? Okay, this individual has never invested in the market before, has got very little to no experience in the market, but has a genuine interest into getting into the stock portfolio right away. Does that have a place for this individual? Of course. Of course, there are options that you can do within the self-managed Roth IRA to trade stock within this particular retirement account. All right? No problem. This individual says, well, what about Tesla? Okay, I'm interested in Tesla. All right. And another thing here is that by nature of this, idea that they want to get right into stocks, I'd probably assign a little bit higher of a risk tolerance to spouse number one. All right. Because if they're interested in stocks, you need to have a little bit higher of a risk tolerance, subject to a little bit more of a downturn. Okay. But when we look at this and take all these concerns into consideration, we drop down here and we say, okay, well, let's go ahead and add the Tesla to this account, if that's what you choose to do, as long as you're doing it within the self-managed Roth IRA account, and you are willing to take Tesla, which is an extremely growing company, and accept a downturn in the stock price, right, of $100 or even $150, right? It's an extremely volatile stock. But if you want to invest in the technology, I love Tesla. I do not own it in my portfolio. I don't want my retirement dollars in Tesla. That's just my personal choice. And I love the company, all right? But I would endorse that particular move if that's in fact what you chose to do. I would just stress that you're investing in Tesla at the expense of a lot of different other technology companies out there that are going to add you a lot safer exposure to the market. Facebook, Google, even an Amazon, I would look to invest in, before a Tesla. But, once we look at that and say, okay, well, let's pick a couple single stocks to start this initial portfolio off for spouse number one here, with the eventual idea that we're going to add diversification within this particular portfolio, with adding maybe an industrial name in there, maybe a discretionary name, maybe putting a Disney or a United Technologies within this. All right. Now, when we look at this individual portfolio and we say, my goodness, this is subject to single stock risk. This particular portfolio is not diversified. You're putting a brand new investor in an extremely volatile stock like a Tesla, all right? I would say yes, but remember, we're putting it into the self-managed account, right? If you go with a traditional financial planner, they're going to take 60% of your profits at a 3% clip over 40 years, right? So I can recommend that as long as these assets are going into the right account, no problem, guys. We can succeed with an infinite amount of options within those accounts, all right? And I'm perfectly comfortable doing so, and here's why. We have the benefit of comparing spouse number one and spouse number two and playing these two accounts against each other. What I mean by that is we have spouse number two over here with a risk tolerance of 3. Spouse number one has a higher risk tolerance, okay? So we go ahead and award this portfolio some assets within that account more indicative of this higher risk tolerance. But when you put these two accounts together, guys, look what you end up forming, all right? These two are married, all right? These two accounts now provide the diversification when they're pitted against each other, all right? Because you've got the S&P index over here, right? If I were to recommend a Johnson & Johnson be bought over here and a Pfizer be bought over here, we're buying within the same healthcare sector, right? But over here, we've got technology exposure and we've got industrial exposure, right? Over here, we've got broad-based diversification over the S&P 500. We're adding a discretionary name, right? So when we put these two accounts together, we're getting that marriage of two accounts, providing that diversification and meeting both individual risk tolerance needs. All right, guys. Listen, thank you so much for tuning in to the video. Again, I can't emphasize enough the importance of subscribing to the channel so you're notified of any future videos that I come out with, guys. Go ahead and push this out to friends, family that you know. Share the link with everybody that you know. Again, I challenge you guys to throw your comments back my way. Give me your age. Give me your amount of investment income, and throw risk tolerance my way on a scale between 0 to 10. That'll give me an idea, of what type of assets to maybe throw back your way, and I'll do some some cost comparison analysis for you guys and some compounding interest. And if I haven't sold you on investing thus far, my sole goal on this particular independent investor channel is to empower one investor at a time, and that's really to understand, the many benefits that exist within the financial world. And guys, thank you again so much for tuning in, and I just want to wish you the best of luck in your guys' investment future.